Alrighty. Hey everyone, welcome to the webinar tonight. We're going to be talking about how to manage threatened SPX credit spreads. And we're going to get started here in just a minute, waiting for everyone to get in the room. And we'll get started here. Hopefully you can hear me fine. All right, perfect. Very good. Okay, so this is a webinar that I put together this month. And it really came about based on the type of market that we've had this year, which is a pretty strong bear market, and definitely challenged my ability to manage these trades. And so I learned a lot this year, and hopefully I'll be able to pass it on to you guys and not go through the pain that I did with managing these. But in any case, so let's get started here, okay? All right, so the first thing is, what can you expect? And that is, I'm going to show you how you can make consistent returns monthly based on margin capital at risk by adjusting trades without taking large losses and make profitable returns month over month, okay? What you're going to learn today is how I went from taking 0 DTE trades and taking losses, 3x losses, which are typical stop losses for 0 DTE. And from that to going to very few losses in several months, okay? And the way that I do that is just because, now I have a way basically to exit trades that are not going to get me in trouble, okay? And not take large losses. And we'll talk more about that. How to identify the strikes and strike prices that you will use to increase your chances of profitability. How best to mitigate a trade that is threatened. The capital requirements to manage in the money and out of the money credit spreads, and this is really important, and we'll talk a lot about that. And the best time to widen spreads to gain an edge on a position. All right, so with that, I'm asking you to stay with us until the end. We have a special bonus for you guys, and we'll talk about that towards the end of the webinar here. Additionally, I'm going to ask you to turn off all your distractions, focus on what we're going to be talking about. I think for you there's going to be a lot of valuable information that you can use like immediately, and also we're going to have a Q&A session. There's a special Q&A section in the chat area, and I'm going to ask you to put your questions there, okay, towards the end of the webinar. And I promise you that I'm going to answer all your questions, but we just want to get through the material and be able to get through it and then answer all your questions, okay? I promise. Okay, so the first thing I'm going to ask is why you're here. Okay, and I put together like 3 reasons why you would be attending this webinar. Reason number 1 is you're interested in learning new strategies that'll take your trading performance to the next level so that you can finally leave your 9-to-5 career behind. Okay, that's number 1. Number 2 is you've read about others making money trading, and you know you can do it too, but you just are not seeing your account grow fast enough based on your goals. And number 3, you've tried different trading strategies that you thought, okay, this is it, only to discover it's not getting you to the place of consistent trading results. All right, so I'm going to put up all 3 here, and then I'm going to put a poll here, okay, so you can see it. And I'm asking you just to let me know which one of these areas that you think that you're closest to, or all 4, okay? So I'm going to leave this poll up here and wait till you guys respond. I'm getting some responses here. Okay, very good. Okay, I'll leave that up there for a few minutes while you guys track that, and we'll move on here. So again, interested in learning new strategies, desire to see your account grow month after month, and find the right strategy that provides consistent trading results. Okay, all right. All right, so I'm just a regular guy, and I live in Puerto Rico with my wife, and my kids are pretty much scattered in different places in the U.S. and they're there in the middle there. And then my parents, and that was a MBA event that I attended long time ago. All right. Okay. So with that, let's start out with having some attention to mindset. Okay. Really important as a trader. The first thing is imagine what it would feel like if most of your trades were winners month after month. And obviously you're going to have losses, okay? But the consistency is what really matters, right? Month after month, and it would be confirmed by watching the size of your account grow at the same time. Number two is becoming the trader that no longer takes large losses, but consistently trades according to a proven trade plan that is profitable over time, allowing you to grow your account month over month. I do have a trade plan, and I've passed it out for free. You know, we have a place that you can download that, and what you're doing is you're actually selling the trade before you buy it. Okay, and you're selling it. You know, you're selling one position, and you're buying the other one. Okay, and the one that you're selling is the one that's more expensive, and so that way you get a credit when you actually put on the trade. Right, so this is kind of the format. This is the format of the position, and these are in Thinkorswim with TD Ameritrade. And so what you're doing here is you're actually, if you're looking at it, you're selling one contract here, and the expiration is 29 August 22. Here's the position that you're selling, 40.50. Okay. So you're selling the 40.50 put, buying the 40 put, all right? And it's called a bull spread, and you receive 50 cents on that trade times the multiplier, which is 100, which would be $50, okay? So that's what you would receive on this trade when you put on the trade, okay? The trade is considered to be a high probability trade, and the reason for that is because you don't have to be exactly right when you trade this, or you don't have to get the direction exactly right. It's based on a range, and as long as the range is not breached, you'll make money, okay? All right, so let's talk a little bit about risk reward, because a lot of people like to have a better reward than risk, right? In this case, it's the opposite. Because it's a high probability trade, you kind of lose some of the risk reward. And so the risk is that you have to risk $1,000, and this is for what's called a 10 wide spread, right? So 40.50 minus 40.40 is 10, and so with that, it's actually $1,000 that you have to put up as margin, and then you receive $50. So basically, what you're doing is you're receiving that $50, and the risk on this trade is $950 because you get that credit. Okay. All right, the max loss is $1,000 again, minus the $50. All right, so we got that out of the way. And again, you'll be able to ask any questions that you have out there. Okay, I'm glad you guys are putting up the questions. Okay, we are going to go through those questions. Awesome. All right, so let's talk about the rate of decay, or decay in options. Okay, because this is really important. And what it is that when an option is not like a stock. Okay, a stock you can buy or sell, and you keep it forever and ever and ever, all right, until the company goes private. With an option, you're actually selling or buying an instrument that has a limited lifespan. Okay, and so let's talk about that lifespan here. So from 60 days to 33 days, an option will decay at a rate of 34%. From 33 days to 5 days, the rate of decay is 57%. And you can see here how it graduates, right? And from 5 days to expiration, it's 100%. So the greatest amount of change, you know, the rate of change happens in the last 5 days of an option. And if we're talking about 5 days, you go to 0 DTE, right? That's even a much faster decay, because by the end of the day, that option is gone. All right, and so that's why there's a lot of popularity with 0 DTE. All right, so let's talk about the profitability factors in options, and this is really important as well. Implied volatility. So the ideal setup is that when when implied volatility or volatility is high and it goes down, what happens is the premium prices go down, okay? And so you want to be in a trade, initiate the trade when the volatility is higher than when it's lower, okay? All right, number 2 is theta. Theta is actually the rate of decay. It's part of the Greeks in options, all right? And the rate of decline in the value of the option due to the passage of time. Basically, that's what it is. And so that's your rate of decay, and it's called theta. And the third profitability factor is market direction. So if you're trading, you can put both sides of a trade on in a vertical. Okay, either you're putting on the put side, or you're putting on the call side. For the put side, you want the market to go up. For the call side, you want the market to go down. Right, and so if you're putting on a bull spread or a put spread and the market's going higher, that's working in your favor. If it's going lower, it's not working in your favor, and vice versa for calls. All right. Okay, so those are the 3 profitability factors, and the greatest of which is actually theta. Okay, because that really causes the decay, and if you're selling options, that's how you make money. All right, and actually, if you're buying options, that decay goes against you, and so you have to be much more right on the position on the direction of the trade than you would have to with selling. All right, so let's talk real quick about some guidelines that I use for risk management. Okay, number 1, you first always want to have a plan. All right. And it should include exit criteria, trade size, composition, etc. All right. Secondly, you want to determine your max loss, and we talked about that, and risk reward. Number 3, you want to trade no more than 20% of your credit margin at risk. So if you have a $10,000 account, you really don't want to trade more than 20% or $2,000 in that account when you're making your trades, because credit spreads require a lot of margin at risk, and you don't want to overdo it. Okay. Also, you don't want to go more than 2% loss in your total trade capital. For highly trending markets, as I mentioned before, you position your trade along the trend if you can. Size your trades to ensure emotions are not part of the decision-making process. I always say trade small, trade often, based on the capital at risk that you have. That way, the smaller you trade, basically the less emotional strain that you have on trading. Okay, and it really helps. Okay, so let's go with pre and post market routines. So first of all, it's really important to understand support and resistance levels. The best tool to use for that is Fibonacci retracement and extension tools. Look it up if you've never heard of that. But those are great tools to use, and I've done a lot of webinars that incorporate that. So you can go out to my channel as well and look up those tools. Understand how the U.S. dollar, treasury rates, and volatility affect the SPX, because those are things that can really affect the direction of the market as well. Understand short-term and long-term trends via, first of all, ES futures, because futures trade overnight, 6 days a week, and understand short-term and long-term trends. And always be prepared to place trades based on your trade plan. All right. Okay. So post-market routine. It's good for you to review your daily activities when you're trading, and what needs to change or not changed in that process. And this list gives you a good example for what to look for in terms of what you're doing in your post-market routine. Okay. All right. Since we're going to talk a lot about zero DTE, I always want to talk about pattern day trader, and this is really important. If you have an account that's less than $25,000, you can get restricted from trading SPX. Okay, and there's other ways to trade outside of SPX, but with stocks, ETFs, if you buy a position and sell it the same day, that's a day trade, and you can only have 3-day trades within a 5-day period, or else your account gets restricted. Okay, so if you have a $25,000 account, that and above, then you don't need to worry about PDT. Okay, all right. How to avoid being flagged, because now it's much more restrictive. Before, they would give you a pass. If you traded three day trades within 5 days, they would basically give you a free pass, and then they reset it, and they would do that 3 times in a year. Now it's just one time. You don't get to reset it. You'll have to move to another broker if you get restricted on PDT. All right, it's really important to understand that. The best way to get around that, and I showed you here a couple ways here. The best way is to trade ES futures, ES futures spreads, options basically, and I trade those consistently, just because overnight you can actually manage those trades on SPX. After 4 o'clock or 4:15, you can't manage those trades. They're stuck, and you have to wait until the opening of the trading session, the daily trading session, to actually manage those. Okay, all right. So let's move on here. All right, now we're going to get into the meat of the webinar here, and talking about managing threatened trades. So basically, what we're going to talk about is out of the money and in the money, okay, calls and puts, and we're mostly going to be talking about puts here, and because on calls you're doing the same thing. All right, so same strikes, lower strikes, and widening strikes, or when you widen your spreads. So those are the 3 characteristics that we're going to be looking at, and how to manage these positions. All right. Okay, so first thing we're going to talk about is 0 DTE. So let's go through 0 DTE and how to how this trade. This is basically a trade plan, and how I trade these positions. So basically, my entry, I enter typically the first 5 minutes of a position, and I use a 10 wide spread. All right. I see, I put up here 5 to 30 because there's variations on different traders, and I'm just going to tell you what I do. The premium that I use basically is between 50 to 60 cents. Okay. And, again, wider spreads, you get more distance to the market, but I'll show you some statistics here on what the best, the best use of those spreads are, and how to use them. Okay. All right. Exit and take profit. I do like to close the positions before the end, but I work with a lot of traders that don't have $25,000 accounts, so they prefer to leave them open until they expire. Okay, and that way there's no PDT on there. But if there's any chance that we're going to get stuck, I just close those trades and then just move on. All right. Okay, expiration, we talked about that, and then trade that's threatened. All right. So I'm going to say here, if you don't have enough margin to manage, to manage trades that you widen, and we're going to talk about widening and the cost of that, then I would really recommend that you use a 2x or 3x short strike stop loss. And what that means is that if you put on a position that's 50 cents, right, and the position goes against you, and you see the premium going from 100 to 150, the 2x is 100, right, and the 3x is 150, and so you'd want to have a stop loss no greater than 3x, so that you can stay solvent. Remember, if you put on a 10 wide spread, one contract, your max loss can be $1,000. Okay, so you don't want that to happen. All right. What I've been doing now too is rolling trades that go against me, and I'm really going to talk a lot about that portion of it, so that you really understand how to manage those trades if they do go against you, and you can do it for 0 DTE, 7 DTE, monthlies, all those things, and manage them basically the same way. Okay. All right. So also, one of the things that you really need to stick by is not allowing these trades to go in the money, right? You always want to manage a threatened trade that's out of the money, and we'll have some criteria to go through that. Okay. All right. So let's talk about putting on these trades here. Now here I'm showing the green is actually calls and the red is puts. These are 5 wide, 10 wide, and 15 wide. So this is 0 DTE for on a 22 VIX, right? Which is in this year it's pretty low. Right now we're around 30. And so what I want to share here with you is that on a 5 wide spread, you're only on your put side, you're only 1.2% away from the market. Okay, on a VIX that's 22, that's at 22. For calls, that's even less than 1%. All right. On the 10 wide, you go all the way up to 1.7 and 1.2 on the calls, and then on the 15 wide, you go 1.9 to 1.4. So you can see here you have a nice big change from 5 to 10, but not so much from 10 to 15. And so when I researched this information, it really is not worth adding an additional $500 in margin for one contract for trading these positions. Okay, so I was trading 15 wide, and I went back to trading 10 wide because it just doesn't make any sense. You don't get a lot of distance in that position to go to 15 wide. I know people that trade 30 wide, as well. And what happens is you get a diminishing return as you go wider and wider out there, and it just doesn't make any sense. Okay, so this is now a 27 VIX, which is not that far from 22, but you can see here that we went from 1.7 to 3.3, and it makes a big difference. It does make a big difference in the volatility. All right. Okay. So now we're going to talk about all the different ways to manage these trades here. Okay. So the first one I'm sharing is 0 DTE, and you have same strikes and next day when you roll. Right. So I'm putting up here a position that is basically has been threatened. Okay. So if you put on this position and it's 50 cents, here it's all moved up all the way to 245. Now remember, I talked about 3x or 2x and 3x, so we're way beyond that now. Okay, and I can tell you that when you're trading 0 DTE, this happens quite a bit. Okay, you go past the 3x, and you have to take a stop loss and you take a loss. All right. And it really does cut into your profits. And so in this case, I'm just sharing here that we went up to 245, okay, and the market was at 35.80, and so we are, and this is the short strike here, okay. So you have a 35.75, 35.65 position, and you're only five points away from breaching or going in the money in this position. So at that point, basically you want to roll the trade. And so under these conditions, and this is later in the day, so when the position gets close to the money earlier, you'd have a smaller credit, okay? And you'd have a larger credit. Your position would be large, higher than 245. It'd probably be like $3 or $4, okay, if it's earlier in the day. So this is later in the day, because the risk is lower, right, that it's gonna breach. Obviously, if it's close to the money during the middle of the day, there's a higher chance that it's gonna breach, okay, rather than at the end of the day. All right, so in this case here, we did a roll for the same strikes going to the next day, right? And I was able to get, using the same strikes, I was able to get $1.75 credit. That means when you roll the trade, you'll receive $1.75 per contract. Okay, not bad. But the next day, the market could continue going down, right? And then you'd be in the money already. All right, so let's move on here. So in this case, same strikes, you get a 1.75 credit. Right, now we're going to rolling the position down and moving it to the next day. So in this case, I moved it down. I could probably have gotten a credit a little bit lower, right? But in any case, you understand that the credit is much lower than having the same strikes. But we were able to push the strikes down 25 points, okay? So you're de-risking more of that trade. It's still kind of close. It's only 25 points away, but you're still able to lower the position and still get a credit on it, okay? All right. So roll down 25 points and a 35% credit. Here we go again now. Now this time we're going to widen the spread. So we're going to go from a 10 wide position, a 10 wide credit spread, and we're going to go to a 15 wide credit spread. And this is what happens. So in this case, if we, I can tell you, I don't have it here, but if we would have had a credit here, the credit, with the same strikes, the credit would have been much, much higher, okay? But we're not really looking for credit. We're looking to de-risk the position because the trade is threatened. So, so in this case, we were able to bring it down from 35.75 down to 35.30 by widening the position. So that takes it much further away than having it, with not widening the position. So that's what it gives you. However, you got to keep in mind that you are paying, $500 per contract of margin in order to do this. Okay. All right. And I'm going to illustrate this with a trade and show you how that margin builds up very quickly when you're getting into worse and worse conditions of a threatened trade. Okay. So here we roll down 45 points and widen the spread and got a 15-cent credit. All right. Now we're going to look at rolling the trade out for 2 days instead of 1 day. And in this case, basically, you can see here that with the same strikes, the credit that you received is higher going out 2 days rather than 1 day. Remember, 1 day it was 175. Now it's 215, right? So that's another characteristic. As long as you're still out of the money, and you push that trade out a little bit further, you get a little bit more credit. At the same time, let me see here. Okay, so rolling 2 days out instead of one gives you a 40-cent higher credit in this case, all right? Okay, so here now we're going to go down and we're going to widen that spread, okay, 2 days out, and for 35-cent credit, you go down to 35.15. I mean, that's a long way, okay? So it's giving you much more distance in this case. So here you're rolling down 2 days, widening gives you 60 points for 35 cents, okay? And if you lower that credit even more, you go down to 15 cents, you can actually get 100 points away from the market, right? So what does that tell you? It kind of tells you to say, if you're going to roll a trade and you really, really want to get it out of the way, you want to widen that spread as much as possible that you can, right, to get it away so that, the next day you're not going to have a problem having that threatened trade. And if you do, and the market goes against you, the probability is that it's still not going to go into the money, and you're going to be able to roll that trade without widening it again and push it down further. Okay. So, this year, I was learning all this, and instead of really being more aggressive and driving my positions down, I kind of did a piecemeal, and it hurts. It hurt me because I'd have to roll the trade again and roll the trade again, so I wouldn't lose, thousands and thousands of dollars. All right. So this way, what you want to do is especially if you're starting out, just do one contract one at a time. If you get in trouble, push it down as far as you possibly can and just keep one position on. And the chances are is that you're going to get out of that trade very, very quickly. Okay. All right. So let's move on. So here you're rolling down 2 days, widening the position by 5 points, and you have 100 SPX points. So if you would have widened it 10 points or 15 points, right? It would have gone down quite a bit more. But again, you have a diminishing return when you're widening these positions. All right. So now we're going to talk about in the money trades, in the money positions. Okay. All right. So here now we have a 35.80 again. That's where the market is, right? And our position is 35.90, 35.80. So now we are in the money. Okay. So here, in the same conditions, but being in the money, your credit is $6.10 compared to what it was when it was out of the money. That was $1.75. So you're already deep in trouble. Okay, and that's why you don't want to be in the money on these positions. Right. So let's go through this and what can happen here. So now, if we wanted to roll this position with the same strikes, you're still going to pay a 90-cent debit. Okay, there's no credit here. You're going to pay you're going to pay for it. Okay. Additionally, if you want to roll it down, so let's go through that. So let's roll it down. Okay. Now you want to roll it down to where we had a small credit for being out of the money. Now you're paying a debit of $3.30. So for every contract that you have, you're basically paying $330. Okay, to recover that or keep that position alive. So that can get very, very expensive, especially when you start widening trades as well. Okay. So in this case, we went in the money. The spread is very expensive to roll down. Now, in the money, roll down and widened. Okay. In this case, we're going to widen the position. And so what do you get here? You get 15 points, basically 15 points down, to get basically a zero credit on it. And so you can see here that it's really not giving you much here of protection, very little protection here. Okay. All right. So now we're going back to 0 DTE out of the money and lowering the strikes and working it and sending it out 1 week out instead of 1 or 2 days. Okay. So here we have the same situation, 250, and we widen this. We actually roll it out and not widen the position, right? And so this gives us quite a bit of distance here. So from let's see if I have that. So rolling it out a week and provide additional distance. Okay, and it'll allow you to actually put on a call spread as well, and that way you're covered. But you're going from 36.90 to 36.20, and so that's 70 points away. And again, it gives you room to be able to, or more room to manage that position going forward as well. Okay, so that's just one of the benefits of rolling out a little bit further. And again, you have to be out of the money here. All right, so in this case, we widened it and pushed it out a week. Here you're actually going down 120, over 100 points here now. In this case, when you widen it and you push it out, a week. And that gives you, again, additional distance, and that's what you want. And you get a credit on this as well. Okay, ready. All right, so now let's talk about 7 DTE. So 7 DTE is very, very similar, or it's a little different than 0 DTE, but it has a lot of the same characteristics, okay? So again, you want to enter small positions, 10 wide spreads, using multiple expirations. And when I say multiple expirations, so instead of taking, let's say you want to put 5 contracts down, you set it out and you put it for a week, right? Instead of doing that, what I would recommend is you put one contract down or two contracts down on Monday, another contract down on Wednesday, and then maybe two contracts on Friday. So what you're doing is you're spreading out the risk when you're trading 7DTE. Okay. What I use is a delta of 10 to 12 for bull spreads and 7 to 10 for bear spreads. And the reason they're different is because I want to have more distance on the call side, because inherently the call side is always closer to the market based on the delta than the put side. Okay. And I think we talked a little bit about that. Take profit is you want to take profit for 50 to 80% of your credit received. Okay, and that's conservative. A lot of times I'll wait for 10 cents, to get out. And if your positions have already been rolled, you want to target less profit on that, just because typically once you roll the position, it's already more risky than putting a new position on. All right, adjustment or roll. I like to use 40 cents, 40 points or more of a threatened trade on the short strike. So you want to, if you're getting, close to those 40 points, you want to, at 60 points and 60 to 40 points, you want to get ready to actually, roll that position and figure out how you're going to do that. Okay. Nobody likes to roll a trade just because you're delaying profit. And those are one of the emotional things you have to battle. But in any case, you want to be prepared mentally and roll that trade before it gets closer and closer to the money, especially if you have a market that's aggressively moving down like we did this year. You want to have time to be able to put your positions on and roll them. Okay. And not be in the money. Okay, and then stop loss. I really roll positions, especially the I don't take losses on put spreads, but on call spreads I do from time to time, just because they're much harder to manage than they are the put positions. All right, so let's go into a 7DTE trade. Oops. In this case here, we put on a put spread with a $1.10 credit, and then a call spread with a 95-cent credit. Okay, and typically they're with the deltas, they're going to be you're going to get less credit for the call spread. As I mentioned before. Okay, in this case, I legged in, and you have a 300+ point range between the two. Okay, so. And what I'm doing here is I created a pretty worst case scenario in rolling trades, right? Okay, so update number one, basically we put that position on and the market went down, okay? And you can see here that that 95-cent credit for the call spread, we had 15 cents here, and so it was ready to be closed, So this trade got closed. And we moved on here. So basically we closed it at 10 cents. We left the put spread alone just because it wasn't threatened at this time. And so after that, we went ahead and put on a call spread, another call spread, lower this time, just because the market was moving lower, and left the bull spread alone. All right. Okay. Update 3 here. The following day, the call spread craters. It went down again, and so basically here you can see here it was close to 10 cents. So we closed this position again. Let's see if we closed it. I think so. Yeah, we closed it. Yeah, we closed the position, and then the market dropped again. All right. And so this time we had to adjust the put spread, okay, because now it was being threatened. So with the put spread, we rolled it from 36.80, 36.70 to 36.30, 36.20. We received a 30-cent credit, and then on the call side, we added another call spread. So this is a third call spread that we added in this one position. All right. So you can see here that even though we are rolling these trades, we're collecting credit along the way. Every single path that we do, we're able to collect credit. And it's much easier to collect it on two sides of the trade, the call side and the put side, because one basically helps the other, so that you can continue earning credit on these positions. All right. Okay. So this time we push it out for 1 week. Okay. And so update number 5 here, right? More downside again, and we had to roll again, both sides. Now this time, the call side wasn't breached, but because the put side, we're going to have to roll it again, and so you want to keep the same margin, right? You don't want to be in different expirations. So we rolled the call side and the put side at the same time, all right? And then what do we have here? So here, because I didn't get enough distance in the market, I rolled it for 60 points, but I used a debit here. And it was okay because we got a lot of credit from the call side, and I didn't mind paying a debit for this position. And again, we rolled the call side, not too much though, because once a market goes down and it's oversold, you can get these rallies that rip really, really hard, okay? And it'll go right against your call spread, and so you don't want that to happen either. And so you got to be kind of careful with that. All right. Okay. So now we collected another credit for the call side, and so now position update number 6 here. Okay. So here again we had more downside, and now this time we needed to roll it and widen the position. Okay. So things were getting worse and worse here, right? So now we roll the positions, and I pushed him. I wanted to push him down as far as I possibly could, and so this time I just collected a 15-cent credit. And again, the call side I collected 70-cent credit, but I didn't want to keep pushing the call side down because I knew what was going to happen in the end if we kept doing that. And so you got to be careful with the call side, because those are more dangerous to manage as well. I didn't mind managing the put side, but the call side can be inherently much more dangerous. Okay, so here we took a 15-cent credit and pushed it out 1 day. All right, because I looked out actually, and it just didn't make sense to push it out further and further. Okay, because I got a good credit on the roll with widening the position. All right, now basically what happens is that the market actually rallied, okay, and it went from 3,500 up to 3,800, okay? And so it was a good thing that we were able to keep that, keep these positions, the call side, above 3,800, but we still had kind of a threatened trade here as well, right? There was a lot of resistance in that area. And so I was kind of confident to keep this thing going. So what happened basically is that we were able to close the positions, right, after the roll that we did, and we were able to close the put spread and leave the call spread open until it rolled. It didn't roll down until the market went down again, somewhat, and we were able to get out for a profit. And so that's really the anatomy here of a really aggressive type of scenario that you can get into. But if you have the right tools and you have the right process, you're not going to get into trouble as long as you keep a cool head and you manage these trades without letting them get into the money. Okay. All right. So now I'm going to take you through another aggressive trade that I went through. Okay, and this gives you a little bit of this one is just okay, here it is. Okay, so in this case here was May 18th. All right, and again, I was kind of green to all this, when I was managing this. But this is one of those days that the market really, really went aggressively against us. All right, okay, so let's go through it. So was managing this trade from 518 to 523. Okay, and it was over the weekend as well. And so I put on the first position, and that position was a 39.50, 39.35 put spread. Okay, and so keep in mind I was still trading 15 wide spreads. So I got 60 cents on this trade. Then what happened from 9:32? Basically, I put on a call spread, and then I added a put spread to the position for 60 cents as well. Okay, the market kept going down, and so I closed the call spread because I knew that I was going to have to manage the put spread, and sure enough, I ended up in the money on the put spread, and then widening the position from 15 wide to 25 wide. Okay, right off the bat, because not so much that I wanted a credit, but I needed to push that position down, so I widened it quite a bit to get it down, and I really didn't get it down that much. So they say luck is not a good trading strategy. Well, I got lucky in this one, I'm telling you. So the next thing that happened is that the market kept going down, and I had to roll that trade again, and this time I widened it to 40 wide. Okay, so I went from 25 wide to 40 wide. Okay, now I was getting in trouble here. So what happened is that the market rescued me. Okay, so the market went way down on a Friday, and on a Monday it went way up, and I was able to close that position for 30 cents. All right, so what happened? So initially had a 15 wide spread. Okay, so two positions, and that's 15 wide, and that is $3,000 of margin. Okay, and I collected basically $1.20. Then on the first roll here, I had to widen the spread to 25 wide, and so I went from 2,500 times 2 to 5,000 in margin here, and then I collected $2.70. And then the second roll, basically I had to create a 40 wide margin, and that was that cost $8,000 in margin. And because I rolled it for a debit, we took off a little bit here, but it was 260 here, and then in the end, basically closing it at 30 cents, we received a credit of 230 for that. But it was not a fun trade, right? And you really don't want to get into that type of situation. All right.